Well, good afternoon, everyone. I thought, yes, I'd change the moniker today to Chief Storyteller for a very important reason, because I think I should tell you a story that you could take home to talk to your clients about. And it's a story that is full of hope and aspiration and maybe a plot twist. It's got some big winners, it's got some losers, it's got redemption, the Shawshank variety, not the unit trust type redemption. A dalliance with luxury and exclusivity. Maybe roll around in some piles of cash, and hopefully we can finish with a happy ending. The whole idea of bulls charging and bears clawing down prices, it's an interesting thing because sometimes I think it's just a mental pain reliever for clients. We're in a bear market, and the whole idea of a sort of a sloth of bears running into the bourse and clawing down prices is easier to be happy with and to take away the pain than the realisation that basically that valuations and earnings don't match and that investors are selling for a very good reason. And on the other side too, on the bull side, essentially you've got, to use the same analogy, you've got sort of the sort of a boat that's sitting on the mooring. It's covered in seagull droppings and crusted salt, and it rises with the lifting tide, in spite of the fact there's a gaping hole in the side. Or more recently, sort of the junior diamond explorer that's suddenly changed its name to .com Limited, and actually even more recently with a sleight of hand has become crypto blockchain. It's a 100-bagger, anyway, for this week anyway. I mean, that's classic bull market stuff. But the reality is, as we all know, a bull market's not a guarantee of making money. Plenty of people lose money in bull markets, and vice versa in bear markets. And what 22 years of experience has told us and taught us is that it's actually hard to make money in all markets. I thought before I'd go on with this story and introduce the plot twist, I might just get a bit of a feel from the audience here where you think we are. Because we've got 300 people here today. That's almost a statistical sample, I think. So who here, hands raised, thinks we're in a bear market? So nobody. Okay, so who here thinks we're in a bull market? Well, that's good. That's less than half though. So that gives me an opportunity because I think we're in a wombat market. and so I've got 10 minutes here to convince you what a wombat market is and explain it, so you can go back to your clients and say, yes, we're definitely in a wombat market. So what does that mean? So this is a quote from my CIO, Mark Arnold, who was published recently. And this is a story we've been talking to our clients about for some time, and that is, I hate to read things, but the world faces a low growth, low inflation, low interest rate environment with headwinds including ageing populations, high debt levels and disappearing middle class and Western economies. And what does that mean? I mean, I'm not going to unpick all of these because I think everybody here gets it, that we're in a low growth. I mean, when I talk about this, I'm not saying this week, this month, this year or the next year. I think this is a 10-year wombat market we're looking at. And there may be periods of frenzy and activity, but the reality is over the next 10 years, we face some serious headwinds. The first headwind there really is low growth. That is low GDP growth, low sales growth, low earnings growth, sometimes just in single digits, sometimes in low single digits, sometimes negative. Credit growth, low. This is a new environment we've been in on a world stage. Certainly we've had a lot of it in Australia over the last 10. So it's very comforting to look at an all ordinaries accumulation graph over the last 10 years since the GFC and see this, this upward sloping chart. But the reality is if you pick out the earnings, they haven't achieved their pre-GFC high yet. It's essentially flat. We've had 10 years of flat earnings. And in the US, it's been a bit better, but it's actually a very concentrated group of companies that have actually delivered that earnings growth. So I don't want to be just, all bad news, but the reality is that the days gone past where you could rely on GDP growth to lift a market into the bull and then absolutely just invest in anything along the way and make money, I think is gone. Just to pick a few of those things there, you're all aware of ageing populations. I don't think we need to go into that. Everybody understands that as this ageing population continues to age, they're going to stop working and growing. It's bulge, and they've produced a lot of the growth over the last 30 years. High debt levels. I mean, the bottom line is that governments and consumers around the world are tapped out. You can only borrow all that money once. Now deleveraging needs to occur, and that's anti-growth. And finally, this hollowing out of the middle class, which actually has some serious connotations beyond growth. I mean, seriously, if you look back over nearly 50 years now, in the 70s, 1% of the population of US controlled 20% of the wealth. Today, they control 40% of the wealth. That hollowing out, which has been caused by multiple factors, whether it's automation or whether it's technology, whether it's outsourcing, whether it's the gig economy, has left the population spread at either end, bookended. It's made substantial difference to political views. So as people spread this way, they actually get different political views, and you can see that in the US and certainly in the UK. So there's going to be some serious winners and losers over this period. And there's going to be obviously some moments where the market gets frenzied and runs up and down, but hey, this is a wombat. It walks around looking for its next meal and Mrs. Wombat. That's basically all it does. So, I mean, this is not an economic environment where people can rely on GDP growth. I just want you to keep thinking about that, is that the real losers out of this at the starting point is passive investment. I mean, I know that's an argument that every boutique in this group will argue, because we're all, focused, detailed investors who don't really believe in passive investing. But put all that argument away. The reality is that if you're just passively investing across markets at the moment, you're going to be exposed to a whole lot of companies that are right there in the headwinds. What you need to do is look at the companies that are exposed to the tailwinds, and there really are some. But before I do that, I thought I might just cover on some of the risks that we see. Not all of them, because there's a lot of them, but some of them that sort of jump out at us and actually are the sort of stocks that might create real hiccups in a wombat market. So high risk developing markets. I've picked China out there as one. It's just one of them. But, you can see the benefit of high tech and what it's done. The Baidus, the Tencents of this world, they've gone on and done terrific work. You can see the earnings have gone up. You can see the prices have gone up. But the reality is countries like China still have substantial issues, and we tend to ignore them and treat them generally as equivalent to what we've got out here in our wonderful country. So, for example, I'll just pick a couple of the things, like the quality of IP protection, the standard of governance, the transparency of asset ownership, the rule of law as opposed to the rule by law. I could really go on for half an hour about all these issues. Accounting standards. Each one on its own doesn't look bad, but when you wrap it all together and then realise that China is essentially a one-person state now controlling it, can you see the risk there? I mean, I just hate to think we're not thinking about this in an environment going forward that is low growth. You've got to protect the downside, and what I'm doing is just giving you some idea of some of the real downsides. For those who are interested, there's a terrific Netflix documentary called The China Hustle. If nothing else you write down today from my presentation, write it down. If you get Netflix, go home. It's an hour and 30 minutes. It's one of the most revealing documentaries I've seen in years. It's also very pleasurable to watch. It's actually a little painful to watch when you realise exactly what's going on there, but give it an hour and a half of your time, and I think you'll enjoy it, and you'll understand what I'm talking about. Look, I've covered some of the other risks there as dot points. Some of the risks involve just old media companies, but just old companies that generally don't get new competition, and that new competition is supported by technology. Now, I know that everybody gets focused on the tech sector, but the reality is technology is sweeping through everything, and if you're sitting there in an old media company and you're not thinking about the competition these days, which is the new media businesses, for example, or new technology companies that are actually knowing their customer better, producing a better customer value proposition, you're sitting right there in the headwinds. So who here, for example, actually reads the Sydney Morning Herald after lunch and hasn't checked some sort of electronic media sometime in the morning? I mean, that's just got to be nobody. Yes, I mean, that's just really what it's... If you don't think it's changed, it really has changed. And so I just encourage you to think about some of these areas that are really much more challenged than people think they are over the long term. That is, they might have short-term runs and there might be opportunities to buy low, sell high, but I'm talking about over the 10 years here. So I said we'd wander through luxury, exclusivity and loyalty. So this is the profitable bookend to the hollowing out of the middle class. At the uber rich area, stocks like Ferrari, Hermes, Moncler, businesses that are absolutely dealing with that top 1%. I mean, who here has, of the ladies here, has a Birkin bag? You know, I didn't expect many, but you know, it's a $30,000 bag, for goodness sake. And yet there's a waiting list to buy them. Who here, I should ask of the men, and maybe the ladies, owns a Ferrari? I saw a hand go up there. Was that really? Fantastic. That's great. So there's a business that has operated with 2% price growth over many, many years and is stuck on 8,000 cars a year, and yet has an 18-month waiting list. And you've got to be a member. If you want the latest supercar, you've already got to own a Ferrari to be able to order it. Like, it's a club. It's an exclusive club. This is a business, I just want to highlight the downside protection. This is a business that through the GFC had its orders drop by 4% when the rest of the luxury car market dropped 40%, 40%. So this is what I'm talking about, businesses with real tailwinds. That is a structural tailwind. That is, rich people like buying stuff that all their friends like buying, and they're not aspirational, they're only buying the best stuff. Similarly, there are businesses like Amazon and Costco, and I'm going to take a different look at them today rather than the standard look that seems to be. I'm talking about clubs. That is, these are businesses where people buy their own loyalty. They'll drive across town to go to a Costco because they've already paid their annual membership fee. And the company, taking a membership fee from all these people, allows it to drop its prices dramatically and compete even better against all the others who don't have that benefit of an annual membership fee. People buy their own loyalty. They're effectively club members. I said we'd talk about cash, new platforms. Clearly, there are the Googles, the Facebooks, the networking, the networked platforms, the employment platforms, the property platforms. These businesses really have redefined how all of these are done, and if you're in the old version of it, you're really just not satisfying the customer. The new version knows who you are and works out exactly how to satisfy you. There's a mountain of cash still in Western economies, still yet to go to card and online. But businesses like PayPal, that didn't exist 20 years ago, have 19 million merchants and over 200 million customers, of which, at the most recent date, 90 million have converted to one-touch payment. Who has one-touch payment on their mobile phone now? Oh, so lots of people. So if you haven't got one-touch, what it does is that when you see PayPal on a website on your phone and you want to buy it, you don't have to get your credit card out. You've already authorised it. You press one-touch. You go to PayPal, it's remembered your address and everything, you go buy, back, and you're done. It's secure, you didn't have to give anybody your credit card, and what it's done is it's reduced the friction. So instead of 40% of baskets being abandoned, only 10% are abandoned. You can see the value proposition to the merchant, and you can see the value proposition to the individual, and it effectively doesn't have, it's so big and so strong and has such a strong first mover advantage, it hardly has competitors. In the same respect, Clever Tech has created businesses that just do it better. They create a customer value proposition that means that the customer wants to come back, buy more next year, or pay more for a higher quality customer value proposition. These are the tailwinds I'm talking about. And if you need to be thinking about that in the global space, because everywhere else it's headwinds. So I promised I'd finish with a happy ending, and this is our version of a happy ending, and that is we launched this fund 4 years ago with the intention of bringing you choice in an area where companies have larger addressable markets and more exposure to the tailwinds than we could find in Australia. Not that we can't find them in Australia, there are just many more of them globally. And so we're having an exciting time doing it, and I just invite you to enjoy and come along with us on the journey.